Welcome back to another exciting episode of Options Beat Stocks. I'm Professor Options, and today we're diving into one of my absolute favorite strategies for traders with smaller accounts, credit spreads.
Hi, Professor. I'm really excited about today's topic. I've been trading stocks with my small account, but the returns haven't been that impressive. I've heard you mention credit spreads before as a potential game changer for smaller accounts.
You're absolutely right to be excited. Credit spreads are like the secret weapon that Wall Street doesn't want retail traders to discover. While everyone else is fighting over pennies with stock trades, options traders are leveraging defined risk strategies to potentially generate consistent income with smaller amounts of capital.
That sounds promising, but before we dive deeper, could you explain exactly what a credit spread is? I understand it involves options, but I'm not entirely clear on the mechanics.
Great question. A credit spread is an option strategy where you simultaneously sell one option and buy another option of the same type, either puts or calls, with the same expiration date but different strike prices. The key is that you receive a net credit when you open the position, hence the name credit spread.
So I'm selling one option at a higher premium and buying another at a lower premium, which means I'm collecting money up front?
Exactly. You've got it. There are two main types: bull put spreads, which profit when the market stays flat or moves up, and bear call spreads, which profit when the market stays flat or moves down. Both strategies give you an immediate credit to your account when you open the position.
That's interesting, but what makes credit spreads particularly suitable for small accounts compared to other option strategies?
That's the beauty of it. First, credit spreads require less capital than strategies like covered calls, which need you to own 100 shares of stock. Second, they offer defined risk. You know exactly how much you can lose on the trade before you even enter it. And third, they can be profitable even if the market goes sideways, something stocks simply cannot offer.
That sounds perfect for someone like me with limited capital. Could you walk me through a real example of how a credit spread works?
I'd be delighted to. Let's look at a bull put spread example. Say XYZ stock is trading at $100 and you have a neutral to bullish outlook. You could sell a put option with a 95 strike price for $3 and simultaneously buy a put option with a 90 strike price for $1.
So I'd receive a net credit of $2 per contract, which is actually $200 since each contract represents 100 shares, right?
That's exactly right. And here's where it gets exciting. Your maximum profit is that $200 credit you received. You'll achieve this maximum profit if XYZ stays above $95 at expiration. Both options expire worthless and you keep the entire premium.
But what about the risk? How much could I potentially lose?
That's the best part. Your risk is completely defined. The maximum loss is the difference between the strike prices minus the credit received. In our example, that's $5 minus $2 equals $3 per share, or $300 per contract. This happens only if XYZ drops below $90 at expiration.
So my risk to reward ratio is $300 to $200. That seems reasonable, and I'm guessing there's a break-even point somewhere?
Sharp observation. The break-even point is the short strike minus the credit received. In our case, $95 minus $2 equals $93. As long as XYZ stays above $93 at expiration, you'll make at least some profit.
What about for small accounts specifically? What's the minimum we would need to start trading credit spreads?
Most brokerages require at least level 3 options approval and a margin account with a minimum of $2,000 to trade spreads. But the real power comes in the position sizing. With proper risk management, you can start with just a few contracts and still generate consistent returns.
Speaking of risk management, what are some best practices to protect a small account when trading credit spreads?
Outstanding question. Risk management is absolutely critical, especially for smaller accounts. Here are my golden rules. First, never risk more than 2 to 5% of your account on a single trade. Second, aim to collect at least 30% of the spread width in premium. In our example, that's $1.50 on a $5 spread. And third, Choose strikes with at least a 70% probability of success. And finally, consider closing positions early when you've captured 50 to 80% of the maximum profit rather than waiting for expiration.
What about timing? Is there an optimal time to enter or exit these trades?
Excellent question. For credit spreads, time is actually on your side due to what we call theta decay or time decay. Options lose value as they approach expiration, which benefits the seller. Many traders open credit spreads about 30 to 45 days before expiration to capitalize on accelerated time decay, and then look to close them within 21 days to avoid gamma risk, which is when price movements can have a more dramatic impact on option values.
That makes sense. But which is better for small accounts, bull put spreads or bear call spreads?
Both can be effective, but it really depends on market conditions and your outlook. Bull put spreads work well in bullish or sideways markets, while bear call spreads excel in bearish or sideways markets. For small accounts, I often recommend starting with bull put spreads on strong stocks at support levels. They tend to be more forgiving for beginners.
Can you give another example, maybe with a bear call spread this time?
Absolutely. Let's say ABC stock is trading at $50 and you believe it's overvalued and won't go higher. You could sell a call at the 55 strike price for $2 and buy a call at the 60 strike price for $0.5. Your net credit is $1.50 or $150 per spread.
And the maximum profit would be the $150 credit if ABC stays below $55 at expiration?
Perfect. You're getting the hang of it. And your maximum loss would be $5 minus $150 equals $3.50 per share or $350 per contract.
So I see how this can be powerful for small accounts. But what are some of the mistakes beginners should avoid?
Great question. The biggest mistakes I see are overtrading, taking too many positions at once, selling strikes too close to the current price just to collect more premium, ignoring important support and resistance levels, and not having an exit plan. Remember, just because your risk is defined doesn't mean you should let losing trades run to expiration.
What about assignment risk? I've heard that's something to watch out for with options.
Yes, that's an important consideration. If the stock price crosses your short strike, there's a risk of early assignment, especially close to expiration. To avoid this, monitor positions closely when they're in the money and consider closing the spread before expiration. Most brokers will also notify you if you're at risk of assignment.
This all sounds really promising for my small account. Any final tips for someone just starting with credit spreads?
Absolutely. Start small. 1 or 2 contracts until you're comfortable with the mechanics. Paper trade first if you're unsure. Stick to liquid underlyings with tight bid-ask spreads, like major ETFs or large cap stocks. And remember the 21-day rule. Consider closing positions when there are 21 days or less to expiration, as gamma risk increases significantly.
Thank you, Professor. This has been incredibly helpful. I can see why you're so enthusiastic about options over stocks, especially for growing smaller accounts.
You know, that's exactly why I created this podcast. Option strategies like credit spreads give retail traders a fighting chance. While stock traders need significant price movements to make decent returns, we can profit from time decay and defined risk strategies even when markets go sideways. It's truly the smarter way to trade with a small account.
One last question. Are there any specific sectors or ETFs you recommend for beginners practicing credit spreads?
Great question. For beginners, I recommend starting with broad market ETFs like SPY or QQQ. They have high liquidity, tight spreads, and multiple strike prices to choose from. Once you're comfortable, you can branch out to sector ETFs or individual large cap stocks with stable price action. Just remember to avoid earnings announcements and major news events, as those can cause unpredictable price swings.
This has been eye-opening. I'm definitely going to study the strategy more and practice with paper trading before risking real money.
That's the perfect approach. Start small, practice consistently, and focus on risk management. Remember, in options trading, defense wins championships. It's not about hitting home runs every time. It's about consistent singles and doubles that compound over time.
Thank you so much for sharing your knowledge, Professor. I feel much more confident about using credit spreads to grow my small account now.
It's been my pleasure. And to all our listeners out there with small accounts, remember, you don't need a fortune to start building one with options. credit spreads can be your pathway to potentially consistent income with defined risk. Join us next week when we'll dive into another powerful option strategy that beats stocks every time. Until then, stay strategic, stay disciplined, and most importantly, stay options-minded.